Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Post-Golden Week blues, China's rally loses steam as traders question Beijing's resolve to add more stimulus. Chinese stocks in Hong Kong see their worst intraday sell-off since 2008. Hurricane Milton barrels towards Florida as a catastrophic Category 5 storm, bearing down on a region still struggling to recover from Helene's devastation. Plus, New York Fed President John Williams says the central bank is well positioned to pull off a soft landing. This as markets eye Fed minutes due tomorrow.
Well, there is a strong risk-off wind blowing in from China. European futures pointing to a lower opening here. Brent back below $80 a barrel despite those Middle East tensions. And yesterday, as we saw Fed bets being dialed back, we saw the 10-year US Treasury yield up above 4% and still hovering above that level now. The countdown to the opening trade starts right now.
Tuesday the 8th, good morning. Welcome to the show. It looks like European equities are going to face a tough start to the day. The reason for it, fairly straightforward. Take a look at what is happening out in China. The expectation had been growing and has been dashed this morning on the rocks of disappointment. We are looking at an equity market that is down heavily in Asia. If you take a look at what is happening with the Hong Kong market, that's probably your best gauge. The Chinese onshore market playing a little bit of catch-up. But, Anna, the sense seems to be disappointment.
Yeah, it does. And you're right to point to that sort of bifurcated response we're seeing in markets, depending if you're talking about those markets that have been open for the last few days. And that's where you get the cleanest read. And that's exactly right, the Hong Kong markets. So we're down by 7.3% on the Hang Seng. Other mainland markets to contrast. But disappointment is right. No new fiscal announcements. I mean, were we expecting any? Doesn't seem as if that was the base case going in. But on top of that, we didn't really get any detail. No implementation plans, our colleagues on the Markets Live blog talked about. And without that, how do you can say that you want to support consumption, but how do you support consumption? What's the policy that's going to support consumption? And all of those questions remain unanswered.
Yeah, all they've really given is saying that China will hit its economic targets this year. But as you say, nothing more to be unleashed for now. You already had the scepticism that some of these Chinese stocks were overvalued, the valuations already stretched. Invesco, JPAM, Nomura, remembering the previous false dawns. And at the moment, it seems like that scepticism well warranted.
Where do we go from here? What do the Chinese authorities now need to do? There is still this emphasis that they are going to make their targets, that they are going to hit those targets. What needs to happen in terms of additional stimulus to deliver upon that? The indications are at the moment that actually the consumers had a fairly good golden week, that actually maybe sentiment is starting to improve a little bit. How do they keep that going?
Yes, absolutely. So if you fold in the latest sort of high-frequency data that we've had out of China, and remember, we got all of those announcements that maybe boosted sentiment a little, and maybe they were designed to do just that, just before Golden Week. Domestic trips are up, more overseas travel, more homes being sold. How sustainable is that if we continue to see disappointment on the detail? But we need to also talk about what's going on in the Gulf of Mexico.
We need to talk about the weather.
Of a cold wind blowing.
Well, I was going to go with maybe a Milton quote, Paradise Lost. Maybe that would be the best way of describing what is looking like is going to happen in Florida. This is a Category 5 hurricane that has accelerated quickly through the Gulf of Mexico. It's expected to make landfall Wednesday, Thursday. The surprising thing is how quickly it has accelerated into a Category 5. Now, it looks like this wind speeds are beginning to drop a little bit, and it's probably expected to make landfall as a Category 3. But this is one of the most powerful hurricanes we've seen in the Gulf of Mexico in over 20 years.
Yeah.
We're recovering from Helene. The devastation is expected to be significant.
Yes, watching whether it does lose steam is important, isn't it? Because only 5 Category 5 hurricanes have actually hit the mainland United States. That's quite incredible. And this is currently Category 5. As you say, there is expectation that perhaps it loses a little as it gets closer. But the fact it is coming only 10 days after Helene, that is going to put added pressure on all of the usual clean-up resources that are in place here. And again, after Helene, there is concern around a storm surge, and that is where you see loss of life, typically in these situations.
And these power outages could last weeks to months, not only, trees being flattened, homes being collapsed, but if you look at the potential economic damage, the expectation is this is going to cost $60 to $80 billion in damage and losses. balances. So really significant, the 5th hurricane to hit the US this year.
Does this change the attitude of people moving to Florida? Huge migration over the last few years. Huge move by kind of out of Wall Street, you could argue, down to Florida as well. Taxation, obviously, a big reason behind that. Does the weather actually start to counter some of that story? I wonder.
Yeah, do people's risk... I mean, everyone has their own risk appetite, don't they? But, yeah, there's certainly parts of North America that they look like there's a lot of weather, and you might not always like that.
Should we turn to the economic weather in the US?
And they're linked, actually, aren't they? Because there's a lot of people asking, are we going to get clean data prints for the next couple of months as a result of this and the strike activity that's either ongoing or paused?
Indeed. So we've had the drip feed of Fed speak over the past 24 hours. We had Kashkari yesterday saying that he still backed that 50 basis point cut in September because of the progress on inflation and the signs of labour market weakness. We heard from Alberto Muslim saying that he supports the Fed's jumbo cut last month, but he wants gradual easing going forward. And we had Williams saying that the US is well positioned for a soft landing. September, not the rule of thumb for how they go forward.
That's it, yes. And a lot of them justifying 50 and saying if they supported it or not. But I was taken by the Muslim comments where he was saying, given where the economy is today, I view the cost of easing too much, too soon, as greater than the cost of easing too little, too late. So that makes me think, oh, inflation is still a concern then in the United States.
So that stands in stark contrast to some of the other comments that we've seen. Kashkari is a bit different. So the sense seems to be increasingly that the Fed made that 50 basis point cut because it's an insurance cut. It knows the economy is fine right now, but it's worried about the tail risks of a slowdown. So it's delivered that 50 basis point cut, i.e. the risks probably favour that. But the comments from St. Louis, I agree, are indicating maybe that actually there are still significant risks of going too fast. And you do wonder what the debate is going to look like and what the minutes are therefore going to reveal. Yeah,
minutes tomorrow. And in the run-up to that, lots to talk to our guests about then, whether it's the China story or the Fed narrative.
Both potentially disappointing for the market. So what have we got coming up? 7:15, we're going to be joined by Sabrina Khanniche, Senior Economist at Pictet Asset Management. 7:30, we're going to speak to Bill Curtin, Global Head of M&A at Hogan Lovells. We're going to talk around the opening trade, try and get a sense of what is happening with these markets with Mike Coop, EMEA CIO at Morningstar Investment Management. Later, we're going to talk about what is happening in the commodity space. Now, there's a multi sort of pronged aspect to this story. One is what is happening in the Middle East. One is obviously what is happening with the China story. And one is what is happening with the Fed and the dollar. Dan Struven, co-head of commodities research and head of oil research at Goldman Sachs, is going to be joining us to discuss all of that, Lizzie.
Yeah, and we have plenty coming up on the docket as well in terms of data and Fed speak. As I say, we've got at 11 a.m. London time, the latest survey on US small business confidence. At 1:30 p.m. UK time, US trade balance numbers. And then the roundup of Fed speak today, we have Raphael Bostic, of course, the Atlanta Fed president, speaking at 5:45 p.m. UK time. Boston Fed President Susan Collins at 9 p.m. UK time, if you're staying up. And as earnings season kicks off, we've got PepsiCo reporting later on as well.
9 p.m. for most people isn't that late, to be honest.
For
us it is. 9 p.m. for most people, not so much.
In normal land.
Yes, in normal land. We get up a little earlier. What else do you need to know this morning? We call it mid-morning. The Bank of Italy has raised concerns about the economy's performance this year. Italy's National Statistics Institute now predicts growth will be around 0.8% compared with the initial forecast of 1%. The institute says the government should concentrate on lowering the country's huge debt. Currently, that stands at more than 130% of GDP. Hamas has fired a barrage of rockets towards Tel Aviv. It did so yesterday, 1 year after the Gaza militant group launched its attacks on Israel. Sirens sounded across central Israel, but the IDF says it intercepted most of the rockets. Israeli Prime Minister Benjamin Netanyahu spoke to troops and vowed to press on with the fight across multiple fronts. And Samsung shares have slipped after the company's preliminary third-quarter earnings missed expectations. The company issued a rare apology for the weak results. Samsung is playing catch-up to its rival ST Hynix, which has taken a lead in producing chips used in AI applications. It's also begun laying off staff as part of a plan to reduce global headcount. Samsung is behind. This is critical because these are chips that work with NVIDIA chips. And it kind of just lays bare the fact that the NVIDIA story is not an isolated one. It needs an ecosystem around it. And competition, particularly with these high bandwidth chips, is huge. Samsung not delivering.
Yes, HBM, as you say, high bandwidth memory chips. And what's interesting here, it seems, for our reporters who cover Samsung, is that this report has been delivered with a bit of an apology to investors. You know, we're sort of sorry that we didn't keep up with SK Hynix on HBM. We are also struggling against TSMC, seems to be the message, on custom-made chips. So a number of reasons that the business felt it needed to apologise for its performance.
Yeah, saying that they've lost their way and really grappling with this potential crisis. Interesting to see how analysts are reacting, so slashing their price targets to factor in the struggles in recent weeks. Macquarie in September had already cut Samsung from outperform to neutral. Let's see if we get some more.
OK, coming up on the programme, the world's biggest iPhone assembler is holding its tech day in Taiwan. Later, we'll bring you some of our conversation with Hon Hai's chairman on his plans to diversify the industry giants. Plus, commodities under pressure as China disappoints on stimulus. Brent dips below $80 while iron ore trades lower. Up next, we'll return to the news flow around China this morning. Sabrina Khanniche joins us, senior economist at Pictet Asset Management. What's in it for Europe from the latest that we know from China? If you have questions, if you want us to add them to our conversations with our guests, please do send us a message. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back, everybody. 7:14 here in London. The European setup today does not look positive. Looks as if we might have worked into our expectations some positivity out of China, and now maybe we are rethinking that. So futures are weaker this morning. China's stock rally has fizzled, with markets reopening after a week's holiday on worries that Beijing will fail to provide more stimulus. The benchmark CSI 300 opened up 11%, but paired gains later in the day. Shares in Hong Kong also tumbled, and of course they've been open for recent trading sessions. So a sort of more in-the-moment reading on what's happening. Let's talk to Sabrina Khanniche, who's senior economist at Pictet Asset Management, joins us on set this morning. Sabrina, nice to speak to you. So let's come at this from a European perspective, because that's I think, your focus primarily. What is in it for Europe, then, around the China story? So there does seem to be some disappointment today around the amount of fiscal spend. Maybe some of the high-frequency data around Golden Week doesn't look too bad. But what are you thinking when it comes to China and Europe?
Well, definitely China is important for Eurozone, given that it is a key trading partner. And obviously the measures that have been announced by China is positive for investor confidence as well as export-oriented companies. We can see that in Europe, clearly the manufacturing activity is struggling. However, we have to keep in mind the lack of transmission of those measures. It would take at least 1 to 2 quarters to impact China economic cycle, and then we need to add another 2 to 3 quarters to impact the Eurozone export. So the effect won't be felt before the end of 2025.
So we see it in the LVMH share price before we see it in handbag sales?
Definitely.
Months before?
Yes, indeed. In fact, we need to look at the measures. So clearly what the authorities is trying to do in China is to target the property market, the equity market, as well as consumer confidence. So they really try to stimulate or to address some cyclical issues, less so some structural issues. But in the end, what is important in China is to stimulate consumer confidence and private consumption.
And is there enough on consumer confidence and private consumption? I mean, I was taken by one of the rather depressing lines that we got from the NDRC that talked about China's external environment being complex and grim. I thought they'd been taking advice on economic doomsaying from perhaps the UK government. But what do you make of their efforts to stimulate the consumer? Are they doing much?
They are doing. So clearly this is what is important in China, to stimulate consumer confidence in order to see a reduction of precautionary savings, which remains pretty elevated, and with private consumption remaining below trend, notably if you look at goods spending. So this is what is key in China.
Sabrina, good morning. From here, is the global economy going to speed up or slow down?
Well, we don't know, actually. So especially if we look at the recent data, the U.S. economy, which has been the key engine of growth, has been super resilient. However, we expect the U.S. economy to slow down next year, so to trade close to potential. We have some stimulus in China, so potentially it could be positive for global demand. At the same time, if you look at the Eurozone economy, which has clearly been struggling recently, if we look at the recent data, there is potential for a recovery going forward, notably driven by domestic demand and driven also by some further easing by the monetary policy by the ECB.
Further easing. how much further are we likely to ease and how quickly do you think it is going to be required? I.e., is the ECB behind the curve at this point? Should it be going faster?
But that's the risk, actually, for the ECB to be behind the growth curve. If we look at the recent data that clearly came on the dovish side, so we had the Q2 GDP, which has been revised down. But most importantly, we saw that domestic demand remains subdued. We expected private consumption to recover. It hasn't materialized yet. If we look at the industrial activity, it remains pretty depressed, notably driven by Germany. And if we look at sentiment, they do point to weaker momentum. So therefore, it is key for the ECB now to act. So we do expect the ECB to cut rate in October and to cut at every meeting until reaching the terminal rate in 2025.
And to what extent would an escalation in the Middle East interfere with the ECB's rate path? Which I suppose is to ask, how much could that offset the China demand hit to the oil price?
Yeah, definitely. So this is what the ECB looks at. Indeed, we know that in the Eurozone, mostly the issue is about services inflation. When we look at the recent inflation report, we can see that there are some easing, but still it remaining pretty high and mostly driven by wage growth. But overall, if we do have a further pressure on prices, on oil prices, it will be reflected indeed in inflation. However, this is not really the key issue when one looks at inflation in the Eurozone. It's mostly about services inflation.
Yeah, I mean, to kind of bring it back to Anna's point, what's up with the European consumer? You've got positive real wage growth, improving consumer confidence, and yet goods spending not rising much. Where's the missing link? Yeah,
that's a very good point. And as you said, we should see private consumption recovering. We had yesterday retail sales for the month of August, and actually they came in line with expectation. But when you look at the carryover, it remains negative. Retail sales remain below the pre-pandemic trend. And in fact, if you look at personal consumption expenditures, so services consumption has done relatively well, while goods spending has struggled to materialize. And I think there are various reasons. The first one being that there is still some uncertainty in the Eurozone with consumers increasing their precautionary savings. Another one being the fact that there is an opportunity cost of consumption rather than savings because of high interest rate. So therefore, with ECB accelerating the easing cycle, it means that savings won't be attractive enough, and therefore we should see further increase of private consumption.
So maybe more spending incentivized. Sabrina, can I ask you about governments and the efforts they're making to fix their balance sheets? Because you see a lot of European governments talking about tax rises. We spoke about this last week, from Italy to France to the UK. There is either the promise or the expectation that taxes in some form go higher to try and fix things. Where do you expect that to have the biggest impact, that sort of increase in the impulse to tax to fix things post-pandemic?
Well, this is good and bad news. Bad news in the sense that this is going to have an impact on the economy, being a drag. So if we look at economic policies, we mentioned monetary policy, which is expected to ease further, clearly being a support for domestic demand. But fiscal policy, clearly there is a shift towards fiscal consolidation in the Eurozone. We know that key countries are under an excessive deficit procedure, so France and Italy. We know that in Germany, the government stick to the debt break rule. So clearly we are in this fiscal consolidation which gained more importance in the Eurozone. And we had the snap election in France. So the government were forced to come with a budget, so which has been announced and will be presented in the parliament this week. But clearly it is about 1% of GDP fiscal consolidation, with potentially, assuming a fiscal multiplier of 0.5, a drag on growth of 0.5 percentage points.
Just talk about tariffs and what is happening with the German auto sector. I'm really curious as to how you're thinking about your models and what you could be potentially plugging in if tariffs increase between the Europeans and the Chinese. The Europeans have increased auto tariffs, the Chinese may respond. How big a difference could this make in terms of the economic outcome that you see coming from your models, and how are you factoring it in to those models?
That's a very good point, and notably thinking about the competitiveness of Germany. So, as you say, Europe has decided to increase tariffs on those electrical vehicles. Germany was not happy about it, and China has already threatened to retaliate with some tariffs on other products. So, and clearly we are in this environment of higher tariffs, so potentially with implication for inflation going forward, and especially in light with also the elections. So we have some uncertainty on this front, whether or not we would see
US elections,
even further tariffs. So overall, this environment of potentially we mentioned supply side shocks, so that would be a factor.
If I can just go back to Barnier, he's got this obviously nightmare situation, having to close the deficit. As you say, Anna, tax hikes expected. But what other choice does he have? Like, where could he cut public spending?
Well, that's a tricky situation, given the fact that Barnier is leading a minority-led government. So obviously, France has to make effort. We saw the cost of borrowing increasing in France, and efforts have to be done. So France has always shown, or most of the time, a primary fiscal deficit. But as you said, it is difficult. So it comes with those measures. So most of the deficit reduction would come from government reduction, government spending reduction, two-thirds, another third via tax revenues, although it has been said that it would be temporary. But let's see if it goes in the direction. But at least France needs to see this fiscal consolidation to be able to bring back the deficit to 3% in 2029.
Given the uncertainties we've talked about the global economy, Sabrina, what are your expectations around how the Fed handles this? We've had a number of Fed speakers overnight talking about, justifying the 50 basis point cut. We saw one of them suggesting a good rule of thumb is just, go with the dots, which is 25 and 25 by year end. Is that what you think is going to happen? Is that going to be appropriate into the year end?
Well, in light with the recent data that have been very strong in the US, and notably the revision we saw last week with GDP being revised up, private consumption and private investment. So obviously we have even a more resilient economy than expected. So we are not aligned with the dots. Actually, we expect the Fed to cut rate by 25 basis points, 2 times this year, another 3 times next year, so bringing the terminal rate to 3.75%, which is above the dots and above the market expectation. And especially in line with the recent data, the labor market report also easing momentum but still remaining strong. So there are even more reason for the Fed to increase the neutral interest rate level and to wait to see the impact of the transmission of the monetary policy.
Sabrina, great to see you. Thank you very much indeed for stopping by to see us. Sabrina Khanniche, Senior Economist at Pictet Asset Management. It's so hard to call right now. You've got a global economy that I think feels like it could go in one of two directions. It could slow down or it could speed up. You've got a US election which is complicating matters. We don't know what the Chinese are ultimately going to deliver. We're still waiting to find out what the details are going to be and actually kind of what size sort of stimulus we're ultimately going to be seeing. We don't know yet what the tariff story is going to look like. There's so many unknowns right now in terms of giving you a prediction. But Europe sort of stands out as an area where it just seems that all the gloom is coalescing.
Yes, and meanwhile, when we talk to investors, they're talking about focusing in on the earnings season as if they're managing to put somehow some of these huge uncertainties to one side and focus in on, who's spending what on AI and who's set to benefit and how resilient are margins and what does the outlook look like and all of that usual stuff that we talk about through earnings season.
Which comes back to the point that you made yesterday, Guy. If the Fed just keeps on adding liquidity, surely there's going to come a moment when stocks wake up and smell the coffee.
Well, we've already, to a certain extent, had a liquidity-driven rally. How much of that has already come? We don't know yet. The Fed is delivering what appears to be insurance cuts. The US economy feels absolutely fine.
Or still maybe just wanted to do it well away from the election because, the alternative would have been moving in November, the day after, where markets might have been really edgy.
Absolutely. That certainly is a significant risk. And you don't even know the result at that point, potentially. So some huge uncertainty, I guess, for investors.
Yeah, particularly, as you say, around the election. And we're going to discuss how the US election affects the deals landscape next with Bill Curtin, Global Head of M&A at Hogan Lovells. Plenty to talk about when it comes to defence, energy. He's coming up next, so do stay with us. This is Bloomberg.
When you look across the valuation space, is it is much cheaper to be able to go out and buy than it is to build. You look at the capital intensity of building new production today, it trades way above the valuations that we see in the market. So it's no surprise to us to have seen these kind of animal spirits in the context of M&A, running for most of this year. We've seen a number of, transactions attempted, nothing as yet kind of concluded in the bigger space.
He was here yesterday, BlackRock's Evie Hambro, speaking to this programme, talking about what is happening in the M&A space when it comes to the mining sector. Rio Tinto making an approach, of course, yesterday for the lithium producer Arcadium. But as he also indicated, we are struggling to get some of these deals across the line. There is considerable uncertainty in the M&A landscape right now. Let's try and get some clarity, though. Bill Curtin, Global Head of M&A at Hogan Lovells, the law firm, joining us now around the table. Good morning.
It's great to be with you, Guy.
Give me some clarity. What's going on?
Well, I'll give you clarity for 2025.
Okay, I'm looking for 2024.
2024, I don't have a lot of clarity for you.
Why not?
Well, today. Yesterday, we have an anniversary of geopolitical crisis, the attack by Hamas, right, of Israel. Today, we stand 4 weeks from one of the most consequential elections in the history of the United States, frankly, certainly in our lifetime.
Yep.
We have not just the executive branch, but we also have the Congress that's in play, very importantly, the Senate side of the Congress in play. So M&A thrives with predictability and clarity. On the other hand, we have reasons for optimism, right? We have our first Fed cut, a half a point, after 11 straight increases, hikes in the United States. We have unemployment down at low levels, right? We had very strong jobs reports in the United States in September, right? We have inflation that's now correcting and coming back into norm. We have the lowest rate of inflation in the United States, the UK, and EU in 3 years. So the fundamentals are there, but it's just lagged before we could, as you just heard from the last commentator, get past these animal spirits that have prevented us from taking off in M&A this year.
You just come around a sort of tour of Europe. What are you hearing? Because in theory, Europe should have some stability right now, but it doesn't. Political instability in France, in Germany, you could argue. You've got an ECB that is cutting probably because it has to. You've got geopolitical issues. You've got Ukraine still ongoing. You've got the issue in the Middle East. How keenly is all of that being felt? Very
much so. And all of those items that you just mentioned, Guy, they drive unpredictability and a lack of confidence. Remember, M&A is also very psychological. M&A thrives, again, with predictability and also levels of confidence in the C-suite. And when you don't have those pieces in play, it's harder for you to take very consequential actions, right? Consequential actions come with great reward and also with risk. So even across the continent here, where things, you're right, have felt a little bit more stable economically than where we've been in the United States, M&A has not taken off here, and that includes private equity. That's not just on the strategic side.
Yep.
The private equity sponsor world, too, has really lagged. In fact, on the private equity side, remarkably, the exit period now for the investments has stretched all the way to longer than 7 years. Just a year ago, it was running a trailing average of a little over 5 years.
Yep.
So they're having to hold on to those businesses for a little bit longer.
Yeah.
Bill, talk to us about, so you're sounding as if, you can't give clarity on 24. What's driving this optimism about 25 then? I mean, because do you have high frequency data that you look at? We spoke to Ralph Schlostein not long ago, and he was talking about active dialogue with clients as being crucial, and that was a positive leading indicator for him.
Well, you're right, Anna. On the private equity side, something's got to give. Right? They've got the capital of their investors, and they have to put that capital to work. I think the valuation gaps have been narrowing over the course of this year. I think on the strategic side, the corporate fundamentals are very strong. We have the strongest capital markets in the United States since 1997 when Bill Clinton was president, and that's beyond the Magnificent Seven. So for some period of time, it was the Mag 7 that was driving the performance of the capital markets. Earnings are strong in the United States. Unemployment is low. Terrific September report, as I just mentioned, right? So the fundamentals are in place, but I likened it, as I said to Guy just a moment ago, to an Airbus 380 trying to get up off the ground. There's a lot of switches, there's a lot of buttons, there's a lot of checks and tests to make sure that plane is going to fly high and far. And it's just taken us more time for us to move through, get the rate cut in the United States, feel the confidence from low inflation, low unemployment numbers, and be able to really take off and go far distances in M&A.
Okay, so in this aviation metaphor, the politics in the United States, is that sort of air traffic control?
Yeah, turbulence.
What turbulence? Yes. What kind of signals and turbulence are you getting from November? What's at stake for M&A?
Well, Anna, you're right to think about that. It's 4 weeks from today. All eyes are on Washington, right? A lot of the pundits are looking at what's happening in the executive branch. I'm very focused on what's going to happen in the Senate. We have 8 of the closest Senate seats are being defended by Democrats, not Republicans, okay? In order for the Democrats to take control of the Senate, they need to win 7 of those 8 seats. That doesn't sound like high probability odds. I'm a lawyer, not a mathematician, but it doesn't make me feel real good if I'm looking for the Democrats to take control. As a result of that, it puts additional pressure and concentration on what happens in the executive. If Kamala Harris is elected President of the United States, then you have some mitigation in the checks and balances system of the United States between a Republican-controlled Senate and a Democrat-controlled executive. But if Trump is elected in the executive, right, then you go in a very different direction, right? So Kamala's tax proposals and the like would not be adopted, obviously, and you have a different-looking economy in the United States, some say.
I mean, do you take a signal from Trump picking J.D. Vance for VP? As a potential shift of how M&A would be treated between the first Trump administration and the potential second Trump administration, given what he's said about mergers?
I think you get two things from J.D. Vance. I think you get Ohio. That was very much a focus for Mr. Trump, and I think very much so you get a pro-business agenda in the eyes of the Trumpians and the Vancians, if we can create that terminology. But I think what's very interesting is you really have two strongly held and persuasively positioned debates in the United States. We have a massive deficit in the United States. Kamala Harris believes we should raise corporate tax. We should disproportionately impact those who are very wealthy in the United States through taxation, and we should start to curb our significant deficit. The Republican view is very different, right? If you start to do those things and you don't let employers deduct compensation of individuals who make more than $1 million a year, you increase the tax on stock buybacks and the like, then you disincent performance in the company sector, among companies, right? And so you have two very different views about how to get the American economy to an even stronger place going forward.
And do you see much of a difference between the defence policy of Kamala Harris and Donald Trump in terms of how it would impact M&A in the defence sector?
Yeah, very much so. And you know, defence, Lizzie, is very active right now. So that's one of the sectors that's continued to be very active, even though we've gone down this year by value and volume in M&A. Defence has been active for some regrettable reasons, right, with what's happening in Ukraine and what's happening in the Middle East right now. Different policies, right? You have a more nationalist, more protectionist type of policy under Trump, and I think you have a bit more of an ally-oriented approach under Kamala Harris in continuation of what Joe Biden has done. So quite different, but in either case, I think the defense activity will continue. Many joint ventures will occur, Lizzie, because of the significant cost and the move to, and the need to move quickly.
Is the supply chain going to be fixed by consolidation?
Well, it's got to be addressed, right? We learned the very, very hard way, and that's really what put us in trouble in the pandemic, right? It wasn't just the stimulus that occurred; it was the supply chain crisis, right? That's why companies like IKEA have consolidated and picked up the supply chain elements to run through their business. So I think it has to be addressed and consolidated, and that's why I think you've already started to see some pickup in M&A, but it's more in the mid-market, not the big-ticket bet-the-company deals.
Bill, from what you've been saying then, I've been trying to get a clear sense of whether you think Harris or Trump, you know, what they mean for M&A and whether one favours more M&A than the other. Like many things, it feels more nuanced than that from what you've been describing.
It really is. 20, 30 years ago, Anna, you could sort of say, well, the Republicans position themselves in the United States as pro-business and M&A will take flight. That 380 will be high and far very quickly, right? It's not as clear now, right? The regulatory environment in the United States is so important. We all know that the FTC and the DOJ have been very aggressive under the Biden administration. We think that Lina Khan holds a lot of the views that Kamala Harris holds. But by same token, while Trump is more accommodating from a regulatory perspective, he also has nationalist tendencies, and he's also got very middle-class working American tendencies that have come into the Republican Party. There's actually a very interesting term that's developed in the Republican Party, and they're called conservatives, named for Lina Khan. Lina Khan, believe it or not, spoke at the Federalist Society convention in the United States not too long ago, which took many by surprise. But Congressman Getz and others in the Republican Party like the fact that she does not kowtow to big tech when it comes to regulatory intervention.
Okay, really fascinating the way that these views are mixing across party lines. Thank you very much. Thank you very much, Bill. Really good to speak to you. Bill Curtin, Global Head of M&A at Hogan Lovells. Coming up on the programme, I'll be back to the China theme. China's rally losing steam as stimulus plans disappoint. We'll see how that may weigh on Europe's luxury brands and the mining sector, part of our stocks to watch, of course. That is next. This is Bloomberg. Welcome back. This is Bloomberg, the opening trade. The opening trade is still 17 minutes away, and it looks as if it'll be negative. A negative start, at least, to the trading session for this Tuesday morning. We are firmly focused on what has been said in China and what the plans are in China to shore up the economy. Let's talk about that now. A rally in onshore Chinese stocks on their return from a week-long holiday has cooled as traders question Beijing's resolve to add more stimulus. And it's that cooling, that negativity that you see reflected in European futures this morning. Shares in Hong Kong have been in strong decline. Joining us now, Bloomberg's Rebecca Chung-Wilkins with the latest. So, Rebecca, we've been up this hill on a lot of expectation, a lot of hope, a lot of fingers crossed, waiting for detail on the China story. Today, some people thought we might get more detail. Was there anything that stood out to you as a key takeaway?
Well, China's top economic planner, the NDRC, announced the invitation to this briefing saying it was going to discuss incremental policies. And it basically did what it said on the tin. We didn't get any mention of stimulus, any mention of the fiscal package. And there was some expectation that that might come because essentially policymakers have been acting with a quite sort of unusual level of urgency. Now, the NDRC typically actually doesn't have a purview to announce, for example, new fiscal support. But there has been such expectation, as you say, that Beijing will try and boost and follow through some of the announcements that it had in that stimulus package right before the Golden Week holiday in late September. Now, the NDRC regulators did put a little bit of meat on the bone when it came to certain policies. They vowed to meet economic goals. They also said it would support loans for some medium-sized companies, for example. It said it would accelerate local government spending from bond sales, also promised ultra-long sovereign bonds in 2025. But we just didn't get any of that discussion or any of those potential fireworks about the sort of fiscal firepower that Beijing might be set to unleash.
But I mean, Rebecca, this is, I think, what Bloomberg Economics expected. You already had scepticism from many strategists. Why are investors so disappointed today?
Well, I think part of it is that there was so much hype going into the holidays. State media, for example, had really hyped up during the Golden Week holiday how well China was doing, touting lots of records and so on. And we also had this state media report that, for example, brokerages had essentially cancelled their holiday plans in order to meet this huge demand from retail investors to open up accounts to trade this rally. And of course, there was this question about whether or not the onshore stock market, which has been closed for about a week during these Golden Week holidays, would be able to match those stellar gains that we had until recently seen in their offshore counterparts in Hong Kong. Now, of course, we didn't get any of that. And we saw, for example, the CSI 300, that jumped immediately about 10%, and it lost about half of that already about halfway through the briefing by the NDRC. We'd already seen some of that pullback as it was very clear that we weren't going to get any more sort of concrete, detailed measures about more fiscal support. So there was quite a quick sort of recalibration, I think, on the ground among investors. And it's a difficult spot in some ways for Beijing, of course. On the one hand, they have really amped up that they are going to support stock markets. But on the other, that then requires sort of constantly feeding investors positive and concrete news. There have been so many false dawns when it comes to promises of support in China that investors are, of course, wary about sort of getting pulled along. And I think there is, on the one hand, while we see a bit of this FOMO, we also see this sort of, trust when we verify attitude among some investors, particularly among foreign investors.
Rebecca, thanks for the update. Greatly appreciated. Bloomberg's Rebecca Chung-Wilkins joining us out of Hong Kong. Let's get another take on what is happening here. Our Markets Live executive editor, Mark Cudmore, joins us now. Mark, how are you feeling about China?
Still extremely bullish. I find some of the perspectives today quite bizarre from investors. I thought Rebecca outlined it perfectly. Look, we are never going to get the big stimulus from NDRC. It's not their role. I know we had very ramped up expectations. But you know what? After today's disastrous collapse in Chinese stocks, the CSI 300 is up 33% over the past month. The Hang Seng Index is up 25% over the next month. If that's a really disappointing monthly performance, give me more disappointing performances. The fact is, just because we didn't get another bazooka of stimulus on the fiscal side today, just because we got only incremental steps, just because we only got thin details on the guidelines of implementing the fiscal side, it doesn't negate we got a whole suite of packages before the break. That was drove with this momentum. Sure, we got excess speculation over the holidays. Sure, things got carried away. We were talking about the moves last week being bonkers on the top side. The fact is, we've still got, across every single Greater China market, 25% is the one-month return or more than that. That is the minimum expected one-month return or what we had. And that is wonderful performance, and it's justified. And I expect that overall, it's not going to be straight line for me. We're not going to get that again. But to think that this has suddenly peaked or topped out just seems bizarre to me.
Yeah. What kind of picture, Mark, are you building of the fiscal stimulus and how important that's going to be? Because it seems as if it was very easy to draw lines between the initial announcements and stocks going higher. But what it means for the global economy, a little harder to pass from some of the commentary that we received over the past couple of weeks.
I think that's right. I think that, some of the numbers being talked about in the fiscal side just seem like crazy. And, it would be wonderful for the global economy and for assets they do that. But then they're just going to stimulate a whole other massive bubble again. And I think that would be slightly crazy. I expect they made very clear they're going to continue to pursue their economic goals. I think they're maybe going to be more steady on the fiscal side, less dramatic as they were across all the market measures last week. But overall, they're going to provide support. What does that mean for the global economy? Remember, the global economy is doing well. Growth is good. US growth is good. Most of the world is growing absolutely fine. Global growth is at 3% this year. It doesn't need extra stimulus. So are they going to provide much more? No. But does it need it? No.
I hear you being extremely bullish, Mark, on China. But look, if there is less China stimulus, if there is less global capital into China, if it is good for the dollar generally, that it's down a touch now, how bad is that for the euro?
But I don't think there is going to be less capital flowing to China. The world is still massively underweight China. I still think there's going to be a reorientation on that. It's just not going to work at the pace of the last month. It's going to be gains of a couple of percent, like normal bullish market gains. Normal bull markets might mean 1% a month or so, not multiple percent a day. So I don't think that the story of capital going away from China is valid. I think capital will still flow to China. I think the dollar overall will probably be soft into year end, but in volatile environments, not a straight line.
Mark, thank you very much. Very good to have Mark's energy on the programme this morning. Bloomberg Markets Live Executive Editor Mark Cudmore, keeping across all of those China dynamics. You can get plenty of analysis from the Markets Live team. MLIV Go, they were covering all of that briefing that we got 3 a.m. UK time from the Chinese, and plenty of detail on the blog around that. Let's get your individual stocks to watch. Joe Easton has a briefing for us. Joe.
Morning, Anna. So we're going to be watching the stocks most exposed to China and Hong Kong today, with the fall in the Hang Seng Index really giving us the best idea of what's going on over in Asia in terms of the disappointment around the China stimulus at the moment. So the two key sectors, of course, will be luxury and also commodities. You'll remember that these sectors both had a decent boost when China recently announced some stimulus. This potentially could ease today. In terms of the longer-term view, remember that all of these stocks are pretty much down sharply on a year-to-date basis. We're looking at the usual suspects in luxury like Kering, Burberry, and then in the miners, Glencore, Anto, a few with heavy losses year-to-date at the moment. Then in terms of insurance, really big declines yesterday as Milton headed towards Florida. That is, expect to make landfall within the next 48 hours, of course, and analysts are describing it as one of the most costly insurance events of the past few years. The stocks that we saw dropping yesterday included Lancashire, Swiss Re, Munich Re, all the reinsurers and all the Lloyd's of London insurers as well were hit. Now, analysts over at Piper Sandler saying that this has the potential to be one of the largest catastrophe events, and uncertainty will continue to hit these stocks until we know the exact amount of the damage. So do keep an eye on insurance once again. Then over in autos, Bloomberg's deals team is reporting that Continental is pushing ahead with the spin-off of its parts unit. Now, you remember there was a profit warning from Continental recently, and analysts actually said that might prevent them from pushing on with this spin-off, but that doesn't seem to be the case, according to Bloomberg's report. And here we can see the decline in Continental recently alongside the broader sector, given those profit warnings. This is potentially positive news on that spin-off today. Then finally, in analyst ratings, a couple catching my eye. Barclays is a buy over at Goldman Sachs. Ubisoft, meanwhile, raised to neutral at UBS amid that takeover interest. And the medical tech company Coloplast is an underweight at Morgan Stanley. That one could be under pressure over in London this morning.
Thanks very much, our equities reporter Joe Easton, with that briefing. And really interesting to put together what we were hearing there from Joe and what Mark was saying. So, Joe flagging, of course, we keep an eye on these China-related names. But these are the moves in the luxury sector yesterday. Kering was up by 4.6%. LVMH was up by 2.7%. So the point being, if we see moves that are much bigger than that, then sure, we're going back further than yesterday. But if we see pullbacks of, say, 4.5% on Kering, that's only yesterday's gain. So there's a longer-term story, is the point.
Absolutely. And I think we're also going to wait and see what the details look like in terms of the Chinese spend story. We're getting this kind of stimulus story, but actually there's a reality below that of what's happening in the economy. And it's going to be fascinating to see just how much the Chinese consumers have spent and on what.
Yeah, so we're currently looking at Euro Stoxx 50 futures lower at 0.75% as we head towards the open. We are 6 minutes away from that at the moment. And if I squint, I can tell you that the FTSE 100 futures are also lower 0.7%. We'll bring you to the open in just a moment. This is Bloomberg.
Tuesday morning, good morning. Cocktail of factors coming together to bring us potentially lower at the get-go of trade in a few minutes' time here in Europe. The first reason is this. European equities rallying hard throughout most of the afternoon. We then get a fade in the United States. That takes us lower this morning here in Europe. Just the simple mathematical, mechanical process that we need to factor in. But, Lizzie, we've also got to think about the China effect this morning. That's going to be in France. That's going to be in London with the FTSE 100 and its minus. But also potentially the chip stocks as well.
Yeah, so we've got Brent back below $80 a barrel on the China story, the disappointment on the fiscal stimulus story. And it looks like futures are pointing to a lower opening in just a few minutes' time. Euro Stoxx 50 futures down 0.8%, tracking the Hang Seng lower, more than 7% it's down this morning. But Anna, some of the individual sectors and stocks that you're watching to feed into this impact.
Yeah, absolutely. So that's the overall picture. Looks negative. Bit of a handover from China on what we've heard there, rightly or wrongly, being factored into markets here in Europe. So we'll watch luxury, we'll watch mining, we'll watch spirits companies as a result of that read across. We'll also keep an eye on insurers. Of course, Hurricane Milton heading towards the west coast of Florida. Category 5 at the moment. Very rare for a 5 to make landfall in the United States. So we'll watch that. Watch Continental as well. It's said to be tapping brokers for a spin-off of its car parts unit. That's going to be in focus. I'll also keep an eye on Vistry. This is a home builder in the UK. A profit warning coming out for them. They've underestimated the costs on some of the builds, it seems, in particular in one particular region of the UK. So we'll keep an eye on that one when we start trading then, Guy.
Absolutely. We are 10 seconds away from the European equity market open. Let's see what we're going to be looking at. I think the China effect is going to be writ large across both France and the UK markets this morning. Here we go. It is time for the opening trade. Stock 600 expected to be a little bit softer. The FTSE 100 is expected to be a little bit softer. FTSE 100 down by 0.2% already. Keep an eye on what's happening with the oil stocks. Keep an eye on what is happening with the mining stocks. Over in France, take a look at what is happening with the luxury story as well. As Anna was pointing out, yesterday we saw a really big rally. Does that start to fade today with some China disappointment coming through? Or are we seeing signs that actually the Chinese consumer has been outspending over the last week, and that should be a positive picture? So, right, here we go. Stock 600 down by now 0.6%. The CAC on open soft. It's down by 1.26%. You probably want to take a look at a two-day chart for the French market to get a clear idea of what is happening. The IBEX is down by 0.7%. Lizzie, what's going on? below the surface.
Yeah, yet again, the Germans late. We'll wait for the DAX. But if we break it down by sector, as expected, bottom of the basket, basic resources down 3.2%. And you can look at some of the miners in particular. Glencore down more than 4%, Anto down 3.6%. Then behind basic resources, you've got consumer products and services down 2.6%. Again, that China read across. Some of the big names in luxury down, Kering down more than 6% currently. But across this basket, Anna, all of the sectors in negative territory.
Yeah, exactly. That is an important point to note. All sectors in negative territory, and you've been through the worst performers. Then just that sort of completing the picture on consumer products and services and the luxury effect. Yeah, down by 5.7 on Kering. We were up by 4.6 yesterday. So we are unwinding what we did yesterday and possibly a little more. Yeah. But let's just keep that in mind. That was the best performer yesterday. Other stocks were not as much higher in yesterday's session, and therefore the move today a little bit more brutal. And there's no denying we are pulling back as a result of what we've heard from China.
5-day charts on MC, LVMH down by 2.2%. If you take a look at it on a three-day basis, the number looks even more aggressive to the downside. Yes, you saw a big rally yesterday, but we are down pretty hard. Today, we're down by 4.8%. If you take a look at a 3-day chart, potentially, you're looking, which factors in kind of 2 days of reasonable gains. Then this morning, we're still down by 2%. So we are seeing a negative picture emerging for the luxury names. Miners and luxury, that's where the points hit is coming through this morning.
Yeah, look, you said Kering, the best performer yesterday. Now it's the biggest loser on the stock 600 today. Insurance, another one that Joe Easton told us to watch out for, hit, of course, by Hurricane Milton, and Swiss Re down 1.5%. So you are seeing that blowback happening as well.
Some individual names that we're watching for. In fact, Continental is open now then. That's down by 2%. We'll get more detail on this in a moment, but there's been talk for a long time about spinning off this business, spinning off the car parts business of that company. So we'll certainly be keeping an eye on that, waiting for Vistry to open after that profit warning.
Yep, let's take a look at the core six. Let's figure out what is happening with the major stock stories across Europe and just get an idea of what the sort of centre of gravity looks like this morning. And as you can see, the centre of gravity looks red. You've got Novo Nordisk, you've got LVMH, you've got Ferrari, which should be red, ASML, all down and down quite significantly. LVMH is down now by nearly 5%. Defensive's doing a little bit better, but still in negative territory. Nestle is down by 0.6%, but Schneider actually reasonably positive, which is interesting. The AI trade story, we've got to watch that, seeing what's happening with Samsung this morning and the read across into the chip space as well. Joe Easton standing by with some of these other stock stories that we've been mentioning. Let's get some details. Joe.
So these luxury stocks really hit hard this morning, Guy. That is the main sector taking the brunt of that move from the Hong Kong stocks. That was the area we were watching, given China has just reopened. But we are actually not yet seeing trading on Richemont and Burberry, which is a bad sign, suggesting too much volatility for those stocks to open right at the start of trading. But we are seeing declines of LVMH and also Moncler standing out over in Italy today. We'll wait for prices on the others. But in the context of the declines we've already seen this year, despite that little bump yesterday, that is pretty significant moves today. But we are also looking at the drink sector, kind of in luxury as well. But we've got some breaking news that China is ramping up some of its anti-dumping measures on the spirits space, and this could potentially be very negative for companies like Remy and also Pernod Diageo. All of those coming down, pretty sharp move lower in Remy. As I say, this is also generally a bit of a luxury play, so kind of the two issues hitting that. But China ramping up those anti-dumping measures is hitting that today. Then, of course, we're looking at the insurers now. We saw a decent decline yesterday across the space and more losses. Now, Lancashire, the Lloyd's of London insurer, was down around 9% yesterday. But again, big moves in Swiss Re, Score and Munich Re. Now, these are massive large-cap companies, so these declines you don't see very often, really showing the impact of that storm and the potential insured losses for those insurance companies. Then we'll also look at the home builders. Not sure if we've got a price yet on Vistry. I'm told by the producer that we do not have a price yet, but I was seeing Vistry cooled down as much as 15%, given they are warning on their costs. Potentially a bit of weakness coming through into demand. We'll have to wait for a price on that one. Then in terms of the morning calls mentioned earlier, Barclays, Goldman Sachs likes this one. This is due to the long-term effects of rising rates, according to Goldman. Potentially that's going to be an overhang in the UK more than Europe for a little longer, so they recommend buying that one. We've also got Ubisoft, a takeover target, of course, given the news around Tencent and the founding family, but coming down following that 30% jump we saw a few days ago. And the medical tech firm Coloplast is seeing weaker margins, according to Morgan Stanley, and this one is cut to under 8, and we're seeing a bit of a move lower in that one. Coloplast falling 2.3% this morning.
Thank you very much. Thanks, Joe. Joe Easton with a look at some of the movers. And we're just getting luxury names, most of them open now, and firmly in the red. Burberry, you pointed out.
Burberry's down. So Burberry's down by 5.5%. But actually, if you take a look at the 3-day charts, 4th, 7th and 8th, including today, flat. So to your point earlier about the fact we've seen some decent rallies in some of these stocks, that is basically being unwound today. We're back to kind of where we were a few days back. Thursday, Friday sessions being unwound, and the Monday session, which are particularly strong. So Burberry is down, but on a 3-day basis, it is absolutely flat.
And we're still waiting for that detail, aren't we, on how these fiscal measures are going to be implemented. That's part of the story. We continue to get lines coming out of China around Golden Week and how that's been doing. I don't think these are new particularly, but we've got domestic tourism spending up by 6.3% year-on-year at October 1st to 7th, so that's the holiday period. Just adding to our understanding about where the Chinese economy is heading at this point. So we continue to factor in that as well. When we come back, we will put all of the latest developments on China, how that is playing out for European markets. We'll put that to our guest. This is Bloomberg. Welcome back to the opening trade. 11 minutes into a European session, firmly on the floor, our feet, that is, today. When it comes to what we're seeing on European equity markets today, a pullback across equity markets. CAC 40 down by 0.9%. We've seen quite a decent move yesterday, higher in some of those luxury names out of Paris, but today certainly a sell-off. That on the back of the comments that we've had from the Chinese, or a lack of detail in some people's minds, something disappointed people. So that seems to be where we are there. I just want to point out what we're seeing in Vistry. We were hearing from Joe that he hadn't got an opening price on Vistry when he was updating us on latest moves. We do now. It's down by 32%. So just to give you the story here, this is underestimating of costs in one of its 6 divisions. Only 9 of the 46 developments in that division this applies to, but still the stock down by more than 30% this morning. We will watch that house builder carefully. Let's broaden our conversation and talk about where we are on markets with Mike Coop, EMEA CIO at Morningstar Investment Management, who's in the studio with us this morning. Nice to have you here, Mike. Your big takeaways or your big view on China right now, because a lot of people got very excited, enough to send stocks up 20% or so on the back of those announcements a few weeks ago. Today we see some pullback. Some people's expectations not delivered on, but others had different expectations. What do you take away, Mike, from what we've seen on China?
I think you've got to step back. It's a volatile market, and so it helps to put into context what's been happening over the last few years when you're looking at the action over just one night. So for us, this had really been a longer-term story. You have a peak in enthusiasm for China back actually in early 2021 around the tech fervor. You then had the market falling hugely out of favour. A huge bear market for 3 years, investors pulling out en masse, emerging market equity funds, excluding China, huge outflows. So really we're at a point about a month ago where you had a lot of pessimism, a lot of underinvestment in what is a large market. So for us, this is more a reflection of super low expectations in terms of what was priced in. So the move was going to happen at some point. The day-to-day reactions are probably the reflection of people getting a little carried away with what they were expecting, but the general support for the market is there. And the main thing really is expectations were just really, really low. And that's why we think share prices will still have further to run.
OK, so you think they've still got further to run to the upside. A lot of noise day to day, as you point out. I mean, some of the underlying reasons why China sold off, concern around tech and concern around just how welcome it is to outside money and how that money is treated when it's in China and all kinds of other things, made some people declare it uninvestable. Do you have a view on the sort of investability of China versus the tradability of China at this point?
Yeah, it's a dominant global economy. Most companies around the world are exporting things either to the US or to China directly or indirectly. So it's not a minor market or country you can ignore. It's a large stock market with some really dominant, high-quality franchises. So to label it uninvestable, that's usually the mark of super bearish expectations on most. So we saw the same thing with energy companies in 2020. So for us, it's not an uninvestable market, but you have to recognise when you're sizing it those unique risks that come with China. So for us, in the multi-asset portfolios we run for advisors in the UK, we have had more than we normally would in Chinese equities because we just felt that the prices were way too low and expectations were excessively bearish.
Tactically, do you take profits?
I think what we're doing is really rebalancing to what our target exposures were. Because when you look around the world and you say, I'm an investor, where can I allocate my capital? And the reality is most markets have had a really strong run this year. Yeah. And the valuation levels on most of the markets are pretty fair or in some cases quite rich. So it's tough to find opportunities anywhere where you can get something for significantly less than what we think is intrinsic value.
And you still think you can see that in China, can you?
We can see that more in China than most other places.
OK.
But these moves are big, and so you almost have to be reviewing this pretty constantly.
So back to my question about do you take profits in China right now? Has the move gone too far in the short term? Do I back off? Do I rebalance away from China? If so, where do I go?
Yeah, I think one of the biggest mistakes investors make is that they can get very anchored on a short-term change in price and not take into account the valuation of markets. And when we look around the world, we still see better value there than most other places.
So one of the places where you see pockets of value is here in the UK. Why and which pockets are you seeing it?
So the UK story, again, it's a bit of a case of looking longer term to see what's happened and why we are where we are today. So for us, when we looked at the effect of why the UK lagged most other markets, it came down to not just the sector mix, but that's a big part of it, not having tech. But it's also, when we look across each of the sectors, that the stocks trade at lower multiples. And while there are some idiosyncratic stocks, UK is really a market of global multinationals in different industries, financial services, commodities, healthcare, consumer goods. And the reason for that is investors, again, labelled the UK also uninvestable in the aftermath of the Brexit referendum vote, where it was pretty unclear what the terms of trade were going to be with Europe. So all of those things really led to, again, people being heavily underinvested in the UK. And at the same time, we had political instability. We had poor financial decisions by the government being taken at the time. We're now in a bit of a different environment where actually the UK appears to have a greater degree of stability and sensibility around the politics than we're seeing in other places.
Are we sure?
Are we, though? Exactly. You know, we're reporting this morning that Rachel Reeves is going to have to walk back on some of the budget measures, private equity taxing, non-doms.
But I suppose those aren't policies that were ever announced, were they? So if you walk back on them and you never announced them in the first place, I suppose that's some definition of...
I think it's just putting into global context what we're seeing here and what we're seeing everywhere else. In the US, the political outlook means there could be some pretty momentous changes. So there's less certainty around things. We've also had some administrations elected in Europe which are also positioning to more extreme policies. So in that situation, there's a more level-headed framework for the way the UK works. It's more a case of it's no longer an outlier.
Yes, and on that very point, actually, Mike, because we all remember what happened to gilt markets under Liz Truss, and some people are watching very carefully, you know, the UK gilt spread with bunds. They're also watching what's happening against treasuries, and some people are a little nervous about some uptick in gilt yields, and they're saying, is this something? Is it a verdict already on what we are likely to hear on the fiscal side, or is this about inflation just being a little stickier in the UK? How do you look at gilt markets at this point?
Yeah, I mean, it frankly looks like noise, if I'm brutally honest. So the UK's inflation localised issues were pretty well documented. Again, some of this from Brexit, when even things like heavy goods vehicle drivers, we couldn't get enough of them. We had supply bottlenecks. Some of those things are being eased, and there's some moves also to change the dynamics of the labour market, which should ease some of the pressures as well. The big one, of course, is gas prices, and that's still a wild card. But that's obviously come down as well. So the global supply constraints no longer as impactful. Inflationary pressures are easing. There's also a labour force issue, more about people returning to a labour force. But all of those things mean that inflation's been slightly higher, but that's come down quite dramatically. And in fact, there isn't really the same degree of inflation differential that there was before.
Mike, great to see you. Thanks for stopping by to see us. Really appreciate it. Mike Coop, EMEA CIO at Morningstar Investment Management. Let's take a look again at what is happening with the luxury names in Europe this morning. Under a little bit of pressure. They've risen over the last few days, so maybe in reality what we're seeing is a rebasing back to kind of maybe Wednesday last week. Let's get a sense of what is happening here. Andrea Felstead from Bloomberg Opinion joins us. Andrea, investors are selling. What's been the picture with Chinese consumers, though? Do we know yet, do we have a handle yet on whether or not sentiment has been boosted?
No, we'll find out in the next couple of weeks, actually, as we're going into the luxury reporting season. All the noise from the last reporting season was that it had deteriorated, and there was an expectation that it deteriorated over the summer. Some of the news points weren't great. I expect we'll get more of that over the next few weeks.
So you're looking at LVMH shares currently lower at 4%. But as you say, kicking off reporting season for the luxury sector next week, what are you focused on?
It'll be the key fashion and leather goods division, and HSBC are expecting that not to have grown at all, which would be the worst performance for many years. But then saying that, luxury's not going to go away. It will be tough in the near term. The next year or so will be tricky. I don't think demand for luxury is going to end altogether, which, a couple of weeks ago, the share prices were almost sort of factoring that in.
And where do you see the sort of the consumer heading next in China then, Andrea? Because we're obviously very much in the moment trying to get a sense of what stimulus is going to be delivered by the Chinese government. Is that what matters for Chinese consumers and what they go out and spend, or what do you see as the
I think
drivers?
It's the overall economy. Obviously, has been not great. Plus, I think some of the brands haven't helped themselves by putting prices up. There's competition from local brands, so you've got that all together. I think it's going to take a little while to sort of shake out. Longer term, luxury is still, I think, undiminished.
China, there's a headline crossing right now. China studying raising tariffs on large engine vehicles. I'm assuming that means that we're talking about some of the luxury names, Mercedes, BMW, etc. Can I assume that, given the fact that we've seen tariffs applied by Europe to Chinese vehicles, that China will look to reciprocate? And do you think that go beyond large engine cars? Do you think luxury names are in focus more broadly?
That is the big worry. That's the sort of the big unknown, that we do get some tariffs on luxury goods, which will obviously be really bad, and that would be in addition to the sort of economic weakness.
Yep.
Worries about greedflation and price increases. That would be another layer of worry to put on top of this.
Do higher prices, just out of curiosity, if prices go up, do people buy more? Are these, to what extent are some of these products Veblen goods, and actually if the Chinese raise the price, they become even more desirable? Are there names that could apply to?
Yeah, is it like that's maybe the case for Hermes and LVMH, but not for the rest?
Well, it really depends. The prices have all gone up a lot. Chanel handbags, a large Chanel handbag is now almost the same price, or around the same price as a Hermes Birkin, which was never the case. There was always a differential. And what we've seen is actually the wealthy are still spending, but it's what we call the aspirational luxury consumer, the comfortable but not super wealthy. they have been affected by those price increases. So what the brands are all trying to do is reconnect with those consumers, build a bridge. And they did that very successfully sort of after the financial crisis. They were their own bridge brands. They brought in sort of lower price products that appealed to those customers. They then put the prices up. We will see that happening again. We've already seen small leather goods, more canvas from LVMH. Mini bags, you'll notice, are a big trend. That's because the smaller the product, you can charge less without diminishing your brand, because that is the
inflation in your handbag.
Yeah, exactly.
Wow.
That is the difficult thing. No. It's you know, what you don't want to do is cut your price. You never cut your prices.
It makes sense though. If everything's on your phone anyway, there's less need to put a load of other stuff in the bag.
But there's things that you can't, you know, there's TikTok videos about what can you actually fit in these bags. They're so small. Nano bags, they're so small.
Nano bags. This conversation has taken an unexpected turn.
It always does.
But this is useful stuff that we only get. We only get from Andrea.
You can use.
Apparently, the aspirational brides are called Henrys. Okay, this is according. I saw this in the Wall Street Journal. High earner, not rich yet.
Ah, okay.
You're a Henry.
Okay, excellent. Andrea, thank you very much. Thanks for bringing us the effect on the luxury sector of what we've heard out of China. Andrea Felstead, of course, from Bloomberg Opinion. Guy, you already mentioned this line, but worth reiterating for what it's doing to car stocks. China studying whether it'll raise tariffs on large engine vehicles. Now, this had been the fear for a long time, and this was why BMW and, well,
it's why the Germans pushed back.
We're pushing back against the idea of applying tariffs to Chinese manufactured vehicles into Europe. And so now the Chinese quite predictably are coming back with their own version of this, and Germany, as feared, seems to be perhaps a bit of a target.
But there was some hint, there was some sort of hint maybe that the Chinese would be more discerning, that they would look and say, Germany voted against this, therefore we will not target Germany's products, we will target those that voted for this, i.e. the French, and maybe that would be the luxury names that would be under pressure as a result of that.
Target the cognac instead of the... Yeah,
precisely.
There has been that talk as well around the drink space. But worth pointing out that, you know, this is a very negative session that we see in front of us today. So the fact that something like Mercedes is down by 2.3%, maybe not too much of an outsized move, but it did move a little leg lower on the back of that particular news line.
Miners are also down pretty hard. So Antofagasta down 5.6%, Anglo's down by 5.32%, Rio's down by 5%, Glencore's down by 4.33%. So the miners, as you can see on the screen in front of you, are under a little bit of pressure. I'm told that home buyers are also under pressure as well. Home builders, not buyers.
Yeah,
home builders are probably under pressure too, to be honest.
33% for Vistry. And going back to the drinks, Remy Cointreau down 6.4%. But it's red across the screen. Every single sector in the red this morning on the Stock 600.
OK, coming up, we will also go to the oil sector, and that's also in the red, down by 1.8% on Brent at 79.46. There's some geopolitics in there, but there's also the response to what we've heard out of China. We are still awaiting, of course, in terms of the geopolitics, still awaiting Israel's response to Iran's missile salvo. We'll get more. We will talk to oil research head at Goldman Sachs. Dan Stryven joins us shortly. That conversation coming up next. This is Bloomberg.
This is the opening trade, 30 minutes into today's session. Here's the recap. Investors are disappointed that we didn't get more detail from the Chinese authorities. The stimulus that was anticipated is not there. As a result of which, while Chinese equities returning today are higher, the cleaner read is the Hong Kong market, which is down by 8.29% going into the close. In terms of that read across here in Europe this morning, all equity markets are lower. China is having a big effect. The London market is down because of the miners and the oil stocks. The CAC 40 is down because of the luxury names as well. There's a few other idiosyncratic stories. In the commodity space, you are looking at weakness as well. WTI crude is softer. Brent crude is down as well, down by 1.77%. Miners are down by 2-3%, pretty much across the board. The Brent story is interesting in as much as it encapsulates two factors we've got to think about this morning. We've got obviously the China factor, which we need to price in, but we've also got what is happening with the Israel story as well. We're waiting to see what Israel will do in terms of its response to Iran. Will it hit the infrastructure? That's what we're thinking about this morning and trying to understand kind of where these commodity prices go next. Dan Stryven, head of oil research at Goldman Sachs, joins us now around the table. How are you thinking about those two stories? You've got, on the one hand, China. We're waiting to see whether or not there's going to be significant stimulus, huge economy, potentially huge amount of demand coming through, particularly for Iranian crude, you could argue. And then you've got the Iranian situation. We're watching to see how Israel is going to respond. How kind of balanced are those two factors in terms of what we're seeing in the oil price?
Yeah. In contrast to metal markets or global equity markets, I think that for the oil market, the potential risks of disruptions to the Middle Eastern supply outlook are more significant.
Right.
Brent is up still 10% from about a week ago. I think the starting point for valuation and for positioning was a very low one, and that helps to explain why.
So where are we now? Have we got back to fair value? Are we beyond fair value? What do you think the price looks like?
We're pretty close to fair value. If I take our models at face value, we're still a few dollars below fair value. The reason is that inventory levels are now somewhat below the historical average. And what's interesting about the rally in oil prices is that usually if you were concerned about disruption risk, you would expect the spot front contracts to rise the most. But we have sort of seen a parallel shift upwards in the oil futures curve, suggesting that the market is potentially also pricing a probability of persistent disruptions. Perhaps the market is putting a meaningful weight on a potential tightening in secondary sanctions for Iran for a long time.
Let me ask you about what kind of disruption we might see in Iran. Picking up on what Guy was asking there, this is what everyone is watching for. Is what we're in this sort of cycle of retaliatory attacks and waiting to see what happens there. And poring over maps of Iran and looking at all of the energy infrastructure. I mean, we on that map we see oil, we see gas, we see refiners, we see pipelines, we see port facilities. Give us a sense of where disruption would be more significant and where it would be less so.
In terms of the significance for crude oil prices, I think that potential damage to the large export terminals would be more significant than the potential impact on crude field production. And I think the smallest impact would be if you were to see damage to refining assets. Export terminals are highly concentrated, and so that poses some vulnerability. If I look at field production, it's fairly spread over a large number of fields, except one large offshore field that is shared with Qatar, which may potentially reduce the incentives for any damage.
Yeah. And if we did see it targeted, so we did see Iranian infrastructure on the energy side targeted, then people start to ask questions about whether there is then an Iranian impulse to shut off the Straits of Hormuz or to interfere with that in some way. What are you thinking? What are you hearing within the industry? Because obviously that brings into play the ability to get out other countries' supplies, supplies that do go very directly into Western markets.
Yes, so clients are very focused on the tail risk of potential interruptions of trade of energy products through the Strait of Hormuz. That concern is very understandable given the fact that roughly 1/5 of global oil supply is coming through that strait. And even if the probability is very low, even if this is very much a tail scenario, it's an important scenario because the main reason why oil prices have not responded very significantly to ongoing wars over the last couple of years is that there is a lot of spare capacity, about 6 million barrels per day, which suggests that if you were to see tightening shocks, in most geopolitical tightening scenarios, spare capacity from countries like Saudi Arabia and the UAE would allow to offset these tightening effects. But that, of course, assumes that these countries can get the oil out. And so even if this is a low probability tail scenario, I think investors' focus on the scenarios is a very logical one.
So you've got the Middle East geopolitical risk, you've got the China demand story, but then bubbling along in the background, we also have the US. We have the jobs report, we've got the Fed minutes coming, we've got CPI as well. Let's say that these fears of a no landing scenario materialise. Where does that leave the oil price?
Is it fears of it? That just amuses me. No, it's nice. It's nice. It's interesting, isn't it, that we talk about it in that context because of what it might do to rate expectations. But actually, a nice problem to have, perhaps.
Yes. I think last Friday's jobs report was quite reassuring, suggesting that the underlying trend for job growth is still sufficient to absorb the meaningful growth in labor supply. But I think it's important to zoom out. 1 or 2 months ago, people were worried about recession risk. And in our view, the U.S. economy remains very solid. Oil demand growth in the U.S. remains solid. And we don't think the probability of a no landing scenario is elevated because the underlying balances in the labor market, the energy market for that matter, auto markets, rental markets, the underlying supply-demand balance is improving. And so we do think that core inflation will come down with a lag and approach 2%. If we were to see a no landing scenario, which I think is not a very high probability scenario, you could actually argue that financial demand for investing in oil as an inflation hedge could rise. So on the one hand, maybe you have slightly slower physical demand growth because of higher rates and therefore tighter financial conditions and therefore somewhat slower oil demand growth. But you could see a pickup in financial demand. Financial positioning for oil remains in the bottom 1% of history. So that could potentially be an offset.
And what about the impact for gold? Because it's already been hitting all-time highs. You see it going higher. How much upside is there in that no-landing scenario?
We think that in our base case, a soft landing scenario where rates do come down and where central banks continue to purchase structurally higher gold amounts, we think that gold has another roughly 10% of upside. You go to 2,900 by early next year. And I think in many alternative scenarios, gold would do quite well. Geopolitical escalation, concerns about the U.S. sovereign debt sustainability, potentially pressure on the next Fed chair. In all those alternative scenarios, gold would perform well.
Is gold a better geopolitical hedge than oil right now?
I think oil is still the best hedge against oil-specific supply shocks. But gold, I think, gives you potentially a broader coverage.
How much are the Chinese paying for Iranian crude at the moment?
It's hard to estimate.
I'm sure.
Estimate that. In general, we have seen over the last couple of years that the discounts on those sanctioned barrels have come down. You've seen it for Russian barrels as well. Once the global supply chain figures out how can I get these barrels, typically there's more demand and the discounts narrow.
So the Chinese wouldn't have to pay much. Say Iranian crude was taken out of the market. Would the Chinese be paying significantly more? It doesn't sound like they would be.
Somewhat more.
Somewhat more.
Okay.
And thinking about oil markets and how they might be disrupted by what might happen in the Middle East, carry on the analysis from, if we do see some... you mentioned refineries, that would be of all the things that could be targeted, that would have a lesser impact. What about the impact of military action in Iran and what it does to refined products, the prices of refined products? Because reading your notes, it was quite a bit more complicated than just, oil prices will go higher, therefore the prices of all the refined products will go higher as well. Talk to us about some of that complexity.
Yes, so I think the most important impact on refined product prices from potentially damage to infrastructure in the oil sector in Iran would be higher crude prices, even if the impact on the refining margins is somewhat ambiguous. So we're more focused on the impact on crude prices.
And surely, actually, the response of oil prices to China stimulus is also different when some of the stimulus, even if it's not as much as they wanted, is going to go into non-oil alternatives. Surely that reaction function change as well?
Yeah, absolutely. So we think the upside risk to our forecast that China oil demand grows by 200 kbd next year, which is only 1/3 of the historical average pace. We think the upside risk is somewhat limited. For one, high-frequency demand data out of the Chinese oil sector suggests that you're running somewhat below our end market expectations. Second, China is important for the oil market, but the U.S. remains the biggest consumer. Roughly 20% of global demand is from the U.S., 16% from China. And third, as you highlighted, we do think that some of the potentially more aggressive fiscal support measures would actually accelerate the transition, whether it is expanding infrastructure for recharging electrical cars, sizing up the trade-up schemes where Chinese consumers can swap their gasoline-powered car for an electric car. And so overall, we think the upside is more limited. I think the Chinese policy put is potentially a green metals put as opposed to an oil put.
Dan, great to see you. Thanks for stopping by to see us. Nice to get an update. Dan Sloan, Head of Oil Research at Goldman Sachs. Quick look at some of the European autos. We've had this news out over the last few minutes that potentially the Chinese may be looking at large-engined European automakers. And by large engine, we basically mean the luxury names, Mercedes, BMW, etc. And as you can see, we are seeing weakness. Now, we're seeing weakness in the luxury space as well this morning. Is there a significantly greater reaction in the autos as a result of this? I think it's hard to discern exactly what is happening here, but we'll certainly keep an eye on this tariff story because potentially we could be seeing the liquor industry being hit as well with some of these tariffs too. Let's turn to the tariff story from a different angle next. Coming up, how small towns across America We'll take a hit if Washington slaps Beijing with further tariffs. That's the subject of today's Big Take. We're going to take you through that story next. It's about trailers for containers and that kind of stuff that doesn't feel like it's important, but you take a look at some of the granularity here. It's a really interesting story. That's next. This is Bloomberg.
Welcome back to the opening trade. We are nearly 45 minutes into today's session, and it's red across the screen. The China read-through very much in show here. The stock 600 lower 0.8%. We're going to dive into the China story in just a moment. But first, I want to talk about what really happens when the US slaps tariffs on China. It's the subject of our Big Take today. Really incredible reporting detailing the impact on the forgotten towns in America. We can talk now to Brendan Murray, who is Bloomberg's trade czar. Brendan, this is exactly the sort of story you used to commission me to write when I was a trade reporter. We've had economists warning for years how messy tariffs are. Do you want to just tell us what was so surprising about the back and forth with China and the impact and why it matters for the US economy?
Right, exactly. So it was back in 2018, and Donald Trump said trade wars are good and easy to win. But if you look back on that observation now, what that overlooks is the casualties in the economic sense that come along with those. This story delves into two companies. They produce the same thing, as you mentioned, truck chassis, one in Alabama, one in Virginia, one owned by a Chinese parent and the other an American-owned company, and they both struggle. And tariffs designed to protect domestic truck chassis makers takes them both down, even though they're both creating American jobs. So this story explains how tariffs are, designed to do one thing, but can really backfire, especially in this case.
It's a bit like sanctions. They always have an effect which is different to the one you think it's going to be, and in some ways they're actually designed to send a message rather than actually deliver an effect. Is that what you think we're seeing here? Talk to us through the sort of the effectiveness of tariffs and the message that comes with them, because it feels like the politics and the economics are on very different pages here.
Yeah, exactly. So businesses, when they're faced with tariffs, find every possible way around them. They will set up in another country. They will set up in their home country. And what happens is tariffs do not move with enterprises as they try to continue to make money. So they seem to be targeted. They often talk about protecting particular industries, but even within one industry, those tariffs can have the opposite effect as they were intended. There's a case of American producers of golf carts that has the same thing. They import Chinese goods, and they're faced with tariffs. We see example after example where tariffs are a very blunt instrument that take down the companies that they're intended to protect.
Now, here's an impossible question, Brendan. What's the future of US tariffs then? Because, of course, we have an election coming up. We know former President Trump has been a fan of tariffs in the past, as you quoted him at the start of our conversation. He has big tariff plans this time around, bigger than the previous, sort of Trump 1.0, it seems. So what are we expecting? What do those in trade circles expect to be the outcome from the presidential election in terms of these tariffs?
Right, 4 weeks from today, the U.S. election. The thinking is that Kamala Harris, if she's elected, will continue along the lines that the Biden administration has. That is a more targeted approach to tariffs, but a heavy emphasis on industrial policy, supporting domestic industries with subsidies and other tax benefits and other sort of incentives. If Donald Trump comes back to the White House, he has said that he will put 10% across-the-board tariff on every U.S. import. That will trigger retaliation from other countries. He's promised a 60% tariff on Chinese imports. You can imagine a sort of cascading effect that those kinds of tariffs across the board would cause. We just had news this morning that China is putting tariffs on European brandy, a retaliation to the European Union's tariffs on Chinese electric vehicle. So you can see that this domino effect of tariffs, this sort of slow erosion of global rules on trade, starts to take effect, and tariffs just become the rule rather than the exception.
Yeah, I'm looking at Remy Cointreau down 8.4% currently. I mean, you've dived in this big take into what happens in a tiny town. What is the big global economy effect if the US maintains this pressure on countries like China with trade barriers like tariffs?
Yeah, we will see countries like even friendly countries to the US like Canada or Mexico. They will be hit with tariffs and they are the two biggest U.S. trading partners. So it just sets off this tit for tat is the phrase they use. But you put tariffs on me, I'll put tariffs on you, and who knows how far that could go. And the inflationary impact of that, and just the erosion of trust among even allies gets even worse.
Yes, you're right to flag to us. It was a couple of hours ago, wasn't it, that we got those lines around brandy. They came thick and fast, though, this morning, because then just more recently we got some lines around how the Chinese are studying raising tariffs on large engine vehicles. And we see, if we look at European automakers today, some of the larger engined end seem to be a little weaker than the rest, even if they all sell off because of the weakness over in China. I mean, where do we head on this Chinese retaliation to the EV story, Brendan? What are you watching next on this one?
Yeah, well, we saw the first wave of it this morning, and it could just keep. The negotiations are ongoing with the Chinese and officials in Brussels to figure out where those tariffs are going to wind up ultimately. The WTO is the entity that is supposed to arbitrate some of these issues. If they can't figure out a way to do this under the WTO system, then it's whoever's the strongest wins. Whoever can put the more economic pressure on the other will come out on top.
Let's talk a little bit about how the Chinese are going to deal with this on a country-by-country basis here in Europe. There's some suggestion that maybe the Chinese say the Germans didn't vote for the tariffs that we've imposed on autos, as a result of which we're going to go more we're going to be fairer to them than we maybe are on the French and the luxury goods space and potentially the drinks industry. Is there any evidence of that?
Well, I think we will see that play out in the products that they put tariffs on in the days ahead. Brandy, is something that's is definitely a politically motivated. Yep. Tariff policy, so that we will see that play out in the days ahead, and Brussels' reaction will be key to that.
Brendan, great to see you. Thank you very much indeed for bringing us the big take and some analysis on the news that we're seeing this morning. Bloomberg's Brendan Murray. Let's talk about what's happening in the tech space. Samsung shares under a little bit of pressure overnight. Third quarter earnings missing expectations. The company issuing an apology, a rare apology, for the weak results, and an unusual admission that is for a company that is grappling with a potential crisis. Joining us now to discover a little bit more about this is our good friend and colleague, Tom McKenzie. An apology. How bad has it got to be for there to be an apology?
It's quite the mea culpa, isn't it, coming through from Samsung, and is indicative of how far they've fallen behind in this race, and indicative of how much emphasis investors in Samsung are putting on the catch-up around AI. Look, the key part of this is they produce these high-bandwidth memory chips, HBM chips that are meant to be coupled with NVIDIA's AI accelerators, the GPUs. You need the two to work in combination to be able to produce and build the infrastructure on which you train these models. They are lagging SK Hynix, their South Korean competitor, by a long way. What we need to watch for going forward is whether or not they're going to get a sign-off, an approval for their most high-tech HBM, high-bandwidth memory chip, to work alongside NVIDIA. Already, in some of their other less sophisticated chips, they are having delays in supplying to NVIDIA. So there's a delay question around some of their chips, and then the most cutting-edge HBMs that they produced, getting that approval, getting the final certification from NVIDIA. We're still waiting for that. The other piece of the pie for Samsung is trying to compete with TSMC in terms of churning out manufacturing, contract manufacturing of chips. There's still a challenge that they're nowhere near at kind of TSMC's levels in terms of the clients they got, in terms of the demand on that front. So this is a real challenge for Samsung. The revenue's down, profits are down. They come out with this mea culpa. Look, if they get the certification of the HBM going forward in the next couple of months, then that will be a step in the right direction. But they'd flagged earlier this year they expected that certification to have come through already, and it hasn't.
Okay. So that's the tech. That's with your tech hat on. Let's replace that with the China watching hat and tell us give us your thoughts on the latest here, because we're clearly seeing this having a real impact on European stocks. Of course, we rallied a long way, and we're not unwinding all of the rally in Chinese assets. Certainly, there's still a lot to show for the rally. But we didn't get any new fiscal announcements. Maybe any expectation of that was misplaced. But we didn't get much detail around what is going to be done. So, for example, you can say you want to support consumption, but there were a lot of people looking for some finer details on what exactly that's going to look like.
Yeah, look, this is a really important but very staid part of the governing apparatus of China, which is the NDRC, the National Development Reform Commission, which is essentially the planning body. That's how they plan parts of this still largely state-run economy. So when they speak, it's important, but it's very dry, and they didn't give a lot of detail. Investors are primed for detail. They need to be implementing the policies, and they need a new detail on the fiscal part of this. At least that is what's being priced into the markets. That is what investors are hoping for, and that's what you didn't get from the NDRC. So a lot of the guests we've been speaking to, the analysts watching this, say, look for the Politburo, look for the State Council to see if additional measures come in. It's much later on in the year. So to your point, can the rally sustain? We did still at 6% upside in the CSI 300, but well below what had been expected for the benchmark. So there's that a mismatch in terms of expectations.
OK, Bloomberg Daybreak Europe anchor Tom Mackenzie, we thank you for the update there on China and on Samsung. As we're looking at the impact of the China disappointment here in Europe, the Stoxx 600 lower nearly 1%. And we were talking to Brendan about the tariff story, China imposing a levy on brandy from the EU, and looking at the stock market impact of that as well. Remy Cointreau down 8.2% off the back. You can see Pernod Ricard down 4.2% as well.
China will start to collect anti-dumping duty deposits on EU brandy from October the 11th, this according to a statement. That came about 2.5 hours ago. So we've got that. And then add on that the auto sector, also under pressure now as a result of a renewed focus there on whether large engine vehicles are going to be targeted.
Luxury names are down pretty hard. Is that an anticipation that we're going to see tariffs being applied to them, or is it just a belief that actually the Chinese aren't stimulating enough to actually drive consumer spending? Anyway, we've got more coming up. Remember that we're going to be having an exclusive conversation a little bit later on today with the JP Morgan chairman and CEO. He, of course, is Jamie Dimon. That's at the bank's Techstars conference. Lisa's going to be talking to him. I really can't wait for this conversation. Hear what he has to say about the Fed and everything else. 2:30 p.m. London time. This is Bloomberg.